All right, we are live with another episode of the Tailored Property Wealth Podcast. In today's episode, we're just going to be doing a bit of a recap over the last month, and there's going to be a couple of different topics that we cover. One of them just being performance for the last month in September. We're going to be talking about the cash rate, what the big four are now kind of predicting with the cash rate. We're going to touch on negative gearing and also the inflation data. So it won't be a massive episode today, but just a little bit of an update of what's going on at the moment and what some of these announcements may and how they may, I guess, impact the marketplace and all the rest of it. So we'll just get stuck straight into property prices over the last month in September 2024. So Sydney pretty much sat flat, grew 0.2%. Melbourne went backwards 0.1%. Brisbane did 0.9%, Adelaide 1.3%, and Perth 1.6%. Hobart 0.4% decline, Darwin increased 0.1%, and Canberra went backwards 0.3%. So combined capitals increased 0.5%. So that's why it's always important to look at the individual marketplaces, because obviously you look at that combined figure, it's grown 0.5%, but there is a lot of variety in there at the moment. And as expected, Brisbane, Adelaide, and Perth continue to perform. And that was a prediction that I made late last year. So kind of on track there. Look, listing levels are impacting some of those marketplaces. We're still just seeing it a lot, even with coming into spring. The stock is still just tight. So Brizzy, Adelaide, Perth stock levels are tight, and that's just the challenge at the moment, especially when we're looking for that quality property as well, right? Some stock can come to the marketplace, but it doesn't mean it's quality. So that's always something just important to remember. Don't just rush in just to purchase. Make sure you're getting the quality property still, because it is important. So if you look at some of the data over the last quarter, Sydney's only grown 0.5%, Melbourne's gone backwards 1.1%, Brizzy's done 2.7%, Adelaide 4%, Perth 4.7%. Hobart, Darwin, Canberra all went backwards as well, almost a percent. So annually, we have Sydney, it's grown 4.5%. Melbourne has gone backwards 1.4%. Brizzy has grown 14.5%. Adelaide 14.8%, and Perth 24.1%. So ranging there, if you have taken action in the last 12 months or 12 months ago, on average, you've done 15 to 24% if you got in those right marketplaces. Then if you've made sure that you've purchased under market value, you're going to have done more in the last 12 months. So some really solid numbers there. Again, people sitting on the sidelines waiting for rates to go backwards is just such backwards thinking. It's going to hurt your cash flow far more long term when you got to go out there and pay 14 to 24% more for the exact same asset. You've got to borrow 80% of that property price increase, and then that means you've got that debt over 30 years. Whereas got in 12 months ago, sucked up the higher rate environment, and you would have done far better off. And getting into the next kind of part of that being the interest rates, where the big four are now predicting that to go, there's going to be a lot more people jump back in now, and it's just going to heat up that property demand, and prices are going to continue to grow. I right now am trying to get finance on more purchases. I have purchased a couple of properties this year. One of those renos will finish soon. I'm going to try and extract equity and get as many purchases I can now before those rates drop next year. Heaps of people flood back to the marketplace because it's just going to, the pressure cooker is just continuing on. Cool. So let's get into, I guess, the Reserve Bank of Australia, what the big four in Australia are kind of now predicting, just the major banks. All right. So as we know, last month, the RBA held rates again at 4.35%. Cool. I'm just going to get up. So the big four, what they're predicting, the Commonwealth Bank of Australia is now predicting that the Reserve Bank of Australia will cut rates in December 2024. And they think that there's going to be 0.25% rate cuts by the end of 2025, taking the cash rate to 3.1%. Westpac, they think that the first rate cut is going to be February 2025 with 4 cuts of 0.25%, bringing the cash rate to 3.35%. NAB thinks it's going to have its first cut in May 2025, but also says it's possible in February, and they're predicting as well 0.25% cuts down to 3.1%. And ANZ is forecasting the first cut to be February 2025 with 3 cuts, bringing it to 3.6%. There's a little bit of variation there, I guess. No one's going to know. The RBA don't even know what they're doing at the moment, so it is hard to predict. Kind of my mindset is I'm kind of thinking probably February 2025. If, for example, CBA are correct and it drops in December, we'll have a celebration, right? But the positive is that across the big four, they're all predicting rate cuts in, let's say, we're in October now, February. I know NAB said May, but holistically, in the next 2 to 4 months, hopefully we're going to see a rate reduction there of 0.25%. And then 12 months from now, we're going to have a pretty big discount in those rates holding property. I did some calculations on what just $1 million of debt would look like with some rate cuts, right? So $1 million of debt, and this is just interest-only repayments, not principal and interest. If we see a 0.25% rate cut, it's going to save us $2,508 per annum. 0.5% would be $5,004 per annum. 0.75% would be $7,500, and 1% would be $10,008 per annum. All right, on $1 million of debt, interest-only repayments. So if you're out there and you're holding $500,000 or you're holding $1 million of debt or potentially more, you can kind of work out what it's going to save you. And there's going to be some pretty big savings. It's just going to help your cash flow, right? We've gone through that last 2 years where it's been a little bit harder to hold property. But if you just have not listened to mainstream media, if you haven't had that scarcity mindset where you just solely focused on what it's going to cost you and you're looking at the benefit from paying that little bit to hold it to get that capital growth and build your wealth base, it's pretty exciting stuff. So cool. That's the RBA rate predictions. I think, we're probably going to see it, I would say, February 2025. That's my mindset, what I'm predicting. Well, not really predicting, but expecting as an investor. If it happens sooner than that, great. All right, next thing, negative gearing. You've probably seen it. This is just something, it's always ongoing. It's been happening for years and years and years. It kind of draws more attention when there's going to be an election around the corner. People start talking about the negative gearing. It's popular. It's a popular thing, right? Majority of the population want to demonize property investors. We're this devilish person that's setting up their future and all the rest of it. If negative gearing is abolished, it's going to discourage investors, right, from entering the marketplace. But we've also got to keep in mind that you never, even if you're investing, wanting something negatively geared, which makes 0 sense, never makes sense to spend $1 to get 50 cents back. I've touched on that before. But the reality is that if you purchase a property today and you're doing it correctly, in let's say maybe 2 to 3 years' time, that property is going to be neutrally geared or potentially positively geared, and the negative gearing really isn't applicable anymore. It is just a short-term thing, but that does not mean it's not going to discourage investors from purchasing property. The issue with discouraging investors is we have a rental crisis going on right now, where if there's less investors, that means there's going to be even less rental properties than there are right now. Vacancy rates are at historic lows. They have improved slightly, but they're still chronically undersupplied from an investment property point of view. That is going to harm renters. It just means that rental properties and rental income will increase. And the renters, they're the true people that will be affected by this. That is the reality of it. People in politics and all the rest of it, whether they don't understand or it's just that popular opinion to get a vote, we won't even get into that. But the reality is that if we discourage investors, it's going to affect the renters, it's going to affect those tenants. Okay. What we need to focus on is supplying more housing. That is the issue we have going on. The government has set all these targets of the number of properties they're going to build. They're not being met. No surprise. They were very ambitious targets. The reality is, add more supply. We have growing population. We have increased demand and higher demand, so we need the supply to meet that. That's what they should be focusing their energy on, not discouraging investors. It makes 0 sense. We are a country with extremely low public housing that the government supply, 3.8%. I'm pretty sure the number is off the top of my head. I haven't looked at that for a while. But if you compare that to some other countries, they're at 20, 25%. So we need private landlords and investors to supply housing because the government is not doing it to the level that they need to. I'm done with that rant. Moving on. I get passionate about that. All right. So long story short, negative gearing is going to be negative for renters, ironically, if it's abolished. All right. So the monthly CPI indicator rose 2.7% in the 12 months to August 2024. So it's obviously dropped from July. So it went from 3.5% in July to 2.7%. So a pretty significant drop, and that is the lowest reading since August 2021, I should say. So we saw housing up 2.6%, food and non-alcoholic beverages 3.4% increase, alcohol and tobacco up 6.6%. So that's a pretty big one. Stop drinking, stop smoking. And transport was down 1.1%. So some positives. And there's been a significant drop, right, because of the energy bill relief. So has it really dropped that much at the end of the day? So electricity prices have fallen 17.9. No, that's not right. So for electricity, the combined impact of Commonwealth energy relief rebates and state government rebates in Queensland, Western Australia and Tasmania drove the largest annual fall. Yes, it is a fall in electricity prices on record at 17.9%. Automotive fuel was also down 7.6%. So that's a positive, and I'm pretty sure everyone can kind of see that out there at the moment, that fuel prices have dropped significantly. I was only thinking about this a week ago. I was at one point paying 2.44 a litre for diesel, and now I think is it 180 or something like that? So it's like 60 cents cheaper a litre. it's pretty big saving. So that is going to be a positive. So that's just some of those outstanding metrics. This isn't all that the Reserve Bank of Australia is going off. There's a lot of things that they're going to look at, the employment figures, all the rest of it. We won't get into it too much today, but the rate cuts are coming at the end of the day. We can see that the US has recently dropped their rate 0.5%. Bank of Canada, they've dropped for a couple of months consecutively. So it's starting to come back into the environment, those rate cuts, and it is close by. So if you're an investor right now and you're holding debt, or if you've got your own occupied property, there's going to be some relief coming in that cash flow. But there's a lot of people, they've just pivoted, they've adapted, they got used to where rates are now. But that little bonus, it's going to be good, and there is a certain percentage of the marketplace out there, right, waiting for those rate cuts to happen. As soon as we see a rate cut happen, there's going to be so many people flood back into the marketplace. We see it now within our business as people are starting to come back in, knowing that rates are about to drop. So just that demand it's still been there in the marketplaces we target. We're targeting those areas prime for growth, but it's going to ramp up. It's going to ramp up a lot. So if you're in a position where you can borrow, now's the time to be getting in. That's what I'm doing. I'm not just saying it. I'm doing it myself. I'm trying to get my hands on as much as I can now, and in 12 months' time, I'll still be investing. But I'm trying to get in. I'm trying to get into as many as I can now. All right, short, sharp one today, guys. Hope that's been insightful, just with a little bit of an update around a couple of different bits and pieces. If you are thinking of investing, you're not sure where or how to do it, reach out to us. We can have a chat about where you're at, what you're trying to do. If you think maybe your interest rates on the debt that you are holding aren't competitive, maybe reach out. We can put you in touch with a really good quality broker as well. They can, kind of check in, see if they can get you a more competitive rate. Just something I want to touch on. This is a question I've got. This is completely left field. Don't always just focus on the best rate in the marketplace, though. When I'm investing, I don't focus on the best rate at all. I understand that I'm not going to get the best rate in the marketplace for what I want to do. I'm looking for the lender that's going to allow me to borrow so I can build my wealth. It would probably make you sick, some of the rates that I'm on at the moment. So high. But the reality is I just hold interest only. The rates are higher. But the capital growth that I'm getting, it far outweighs that. And what I'll do is in 6 to 12 months' time, as a proactive investor, I'm going to go out there and just refi that property, get a better rate at that point in time. But the capital growth that you can get in that 6 to 12 month period in an area prime for growth, under market value, and then if you throw a reno on top of that, just far outweighs that higher interest rate. And look, my risk level is higher than a lot of people, but just don't always focus on that interest rate alone and getting the best interest rate in the marketplace. Because if you're looking at those lenders, they might say, no deal, we won't give you any, but you go to a lender with a higher rate and they say, yeah, we'll give you the money. So do you want to get into that next property or not? That's the question. Anyway, left the field. Thanks for listening, guys. Have a great day, and we will see you next time.